Hi everyone, welcome back to Corporate Decoder. Ever wonder what happens behind the closed doors of corporate America? Today we are diving into the world of S&P Global through its latest proxy statement, which is a document every shareholder should peek at before casting their votes. Think of it as a behind-the-scenes pass, but instead of celebrity gossip, we get to dissect executive pay and board decisions. It's like being a fly on the wall, if that fly was also a financial analyst. Let's start with the highlights from the proxy summary. This document is S&P Global's way of saying, here's what you need to know before the big shareholder meeting. First off, the big numbers. Revenue is up 14% to $14.2 billion. Net income is up a whopping 47%. Basically, the company is making more money and keeping more of it pretty good. They're also throwing a party for shareholders by buying back shares and paying dividends, totaling $4.4 billion. It's safe to say S&P is doing well when they're dropping billions like it's pocket change. There's a change at the top with Martina Chung taking over as CEO. It's like a carefully planned royal succession with Douglas Peterson sticking around as a senior advisor until the end of next year. That way he can pass on his wisdom. Looks like this was more of a planned baton pass rather than a corporate coup. Time for a quick look at the board. 9 directors are up for election. It's like choosing your favorite characters in a TV show, except these folks control a multi-billion-dollar company. They also have a skills matrix, which is a fancy way of saying, here's why these folks are qualified. Shareholder engagement is a big deal for S&P. They're all about that active dialogue, which is a corporate way of saying they actually listen to their investors, well, some of the time. Risk oversight is the board's job, and cybersecurity is on their radar. They even get reports from the Chief Information Security Officer. It's like having a techie superhero watching over the digital kingdom. Here's where the compensation discussion begins. The goal: to attract, motivate, and reward the executive talent needed to achieve company objectives. In short, it's a way to keep the big bosses happy and performing. The annual incentive payouts are tied to goals for non-GAAP adjusted EBITDA margin and non-GAAP adjusted revenue. Think of it as a bonus based on hitting financial targets that get adjusted for all sorts of things. The long-term incentives are tied to non-GAAP adjusted EPS targets. They have features to manage risks like stock ownership requirements and clawback policies. So executives have to own a piece of the company and could lose pay if things go south. Now we're diving into the compensation discussion and analysis, the CD&A. This section explains how the company pays its top executives and what they did to earn it. Revenue is up 14% and net income jumps 47%. Prudent management of expenses is mentioned, while also returning over $4.4 billion to shareholders. They returned the cash in dividends and share buybacks. Total shareholder return was about 13%, in line with their peer group, but a little behind the S&P 500. This means while shareholders made 13% back on their investment, the S&P 500 returned investors 25%. Enterprise level ST funded at 151.29% of target for 2024. The 2022 long-term performance share unit award earned below target at 40.07%. So short-term wins, but some longer-term goals not quite there. The new CEO's targeted compensation mix is different from the old one. She is expecting 92% of her compensation to be incentive-based. The company has policies on stock ownership, hedging, and clawbacks. Stock ownership ensures executives are invested in the company's success, while clawbacks let them get their money back in case of bad behavior. Think of it as a corporate insurance policy against executive shenanigans. Next, the compensation framework explains the logic behind how executives get paid. Pay elements include base salary, short-term incentives, and long-term incentives. The goal is a mix of compensation that motivates performance while aligning with shareholder value. About 86% of the new CEO's compensation is incentive-based. So she's really incentivized to improve the company and stock price. The section of performance assessment and compensation determination talks about how the roles and responsibilities of setting compensation are handled, and also considers external market analysis. The company then compares itself to a select set of comparable peers in the market to make sure they're not under or overpaying its executives. These peers included major players like American Express, BlackRock, Moody's, Visa, and more. They are similar companies S&P competes with to hire the best executives. Internal pay consistency is considered too. Lastly, the bigwigs can't use company funds to gamble on meme stocks because there's a risk and control division that prevents reckless decisions. They are paying the old CEO to be an advisor, a base salary at an annual rate of $1.5 million, and will be eligible for a 2025 annual bonus target of $3.5 million in stock. For being a senior advisor, more financial performance overview, going back to the revenue increases of 14% year over year with EPS growth. The actual annual incentive payout for the current CEO was $2.6 million. The incentives are there to ensure that the CEO does well, the company also does well, and shareholders reap the rewards. And then it goes on to explain the financial performance for each of the other top executives and how it influenced their pay. It's all very specific but very similar. Finally, insider trading policies are important in making sure everyone is playing by the rules. Lastly, the directors' compensation table. Basically, the company pays the non-executive board members in cash and stock. Most of them earned just above $350,000 this year. So what's the story here? S&P Global seems to be in a strong position and made good decisions during the latest change of management. The numbers are looking pretty good and the company seems well prepared for the future. There's a shareholder proposal to strengthen the clawback policy. The board opposes, saying existing policies are already broad enough. This comes down to different risk attitudes, the diverse team of directors and a clear performance-driven structure. There's every reason to believe S&P will continue to generate profits. Thanks for tuning in to Corporate Decoder. If you found this breakdown insightful, don't forget to like, comment, and subscribe for more behind-the-scenes looks at the world of big business.